Hello, everyone. Here's our presentation on an investment opportunity. Our teammates are Harsh, Michelle, Hans, Ignacia, and Nikita. Ignacia will start by introducing the presentation.
Okay, thank you, Michelle. So what will happen to the markets? Will they rise or continue to fall? What do I do with my money? Do I invest it or not? In which financial instrument in that case? All these are some of the many questions we usually hear in these days, months perhaps, where there is a high level of uncertainty and where investors do not want to lose their money and want to bet on the best investment in this scenario. But what scenario are we really in? This is the first question that we must answer before going into the investment recommendation that we will show you in today's presentation. So first, as you see in the graph, economists increasingly think the US is heading for a recession. What are the odds and how bleak is the outlook? The Wall Street Journal latest survey of economists put the probability of a recession in the next 12 months at 63%. So the answer is yes. With a high probability, we will enter a recession in 2023, and the market is anticipating that. Second, with an annual inflation rate of 8.2% at the end of September, the Federal Reserve approved the largest interest rate increase since 1994, and signaled would continue lifting rates this year to fight inflation. What is the challenge of this? If the central bank raises rates too sharply, it risks cooling demand so much that it drives out of work. But if central bankers don't raise rates enough, they risk higher and higher inflation, which is arguably worse in the longer term for consumers and businesses. So if you see the following survey, If we see the following survey made by the Wall Street Journal, show that economists think the rate hike could lead to an even deeper weakening of the economy. Therefore, even if we expect a recession next year, we should be worried of it being deepened by further interest rate hikes by Fed. And third, if this were enough for the US economy, we should also be concerned about the rest of the world and where we want our investments to go. The impressive strengthening of the dollar has led to depreciation of many currencies around the world, which have been affected mainly by the increase in their dollar-denominated debt and more expensive imports that affect inflation in their country. We also should pay attention to this. So having said all that, and with economic context clear, we should answer the following two questions throughout the presentation. First, which one is the best opportunity investment in this scenario? And two, which one is paying us enough to take on the risk? So to answer this question, we will analyze two financial instruments during the presentation: fixed income and gold. So Michelle, you can go first.
Thank you, Ignacia. We'll be analyzing our first investment opportunity. How much money can you make or lose investing in gold? You would have no idea. What about oil? It's worse. And technology stocks? It's very difficult. On the other hand, when you're trying to figure out how much you would win or lose with treasury bonds, it's very precise. When you think about buying bonds, you have to think about the expectation of the economy and markets. Now, Ignacia has already explained that we're coming into the recession. So the only thing we have to think about and select is you have to think which of these are paying us enough to take on the risk. There are different types of fixed income products, and we're going to focus on two: corporate and government bonds. There are three important ETFs that you should know about. There's TLT, which is a basket of 20-year plus treasury bonds. There's high yield corporate bonds, and LDQ. The benefits of fixed income is that it offers a steady stream of income, meaning you will receive coupon or interest payments. Also, treasury bonds and bills have backing from the US government, so there's almost no risk of default. Here we can see the annual returns for TLT. And for example, in 2008, there's a positive return of 33%, and 2009, a negative return of 21%. So as you can see with TLT, you can lose a lot of money or make a lot of money. You can also see it in more recent years of like 2020, we have a 17.92% return and a negative return of 4% on 2021. It's almost a 22% difference, which is quite a lot. So as you can see, it's very volatile, but you have the security of the US government because they can always print money, so there's almost no risk of default. Here you can see the graph over the years of TOT. As you can see right now at the very end, so the total returns as of October 20th, there is a negative 35% return. This shows you that it's a great time to buy because, as Ignacia told us, we're going into a recession. So we're expecting it to go up afterwards. So it's a great opportunity for investors to invest in TOT, given that it's on a very good price right now. Also, we know that there will be the Fed tightening more. So it's just a great opportunity. Here we see two different lines. We see the graph for the TLT 20 plus year treasury bonds and the high yield corporate bonds. You can see that it's almost in reverse. And the difference between both of these is that you should invest in HYG when the economy is strong because the risk of default would lessen. And on the other hand, you should invest on TOT when the economy is weak. When wondering which to invest in, as I said before, you have to look at the state of the economy. And since right now we know that the Fed will keep rising rates and we're going into a recession, the best option for right now is TOT. Now, Hans will move on and talk about fixed income and hedge funds.
Well, thank you, Michelle. So we had the idea of investing in fixed income. So the question is, how should we do it? As we know, there are multiple ways in which we can invest in fixed income ETF. One, of course, is through a broker. We call all the shots. And the other is to put the money on a hedge fund that follows a fixed income strategy, right? So what if we decided to invest in a hedge fund that follows this kind of strategy? I mean, we all know that hedge funds base their operation in investing, so they usually have the proper structure and have experts on the matter. So which one is more convenient? I mean, it's going to depend, of course, on how would you like to be in charge, how much, and how much are you willing to pay in fees. So in order to have an informed decision, to have more data to take the decision, we're going to look at a few numbers of the performance from a few fixed income ETFs, and of course of the hedge funds, how have the fixed income hedge funds performed in the last year. So the first slide, the first numbers we're going to see. Here we have the top 5 ETFs of fixed income in terms of assets under management. Well, all of them are a lot of money, over $35 billion. And we can see that the performance in the last 3 years has been nothing but negative. These are all ETFs of very big investment companies, Vanguard and BlackRock, and they have really bad performance. What if we look at the hedge funds? If we look at the hedge funds, we can see that the hedge funds that follow a fixed income strategy in the last 3 years have had a return of 5.78% positive. So, of course, positive 5.78, it's much better than -1, -2, or -5. So sounds like a good idea to invest on our money with hedge funds. But what if we look some other ETFs? So in these slides, we have, according to ETF.com, the top 5 fixed income ETFs in terms of performing. All of them have a lot of assets under management. All of them are for very big companies as well. And we can see the 3-year return is over 10%, over 13%, which is double and more than double the performance that hedge funds had in the last 3 years. So to summarize a little, here's the complete information. We have the top 5 in terms of assets under management, the top 5 performance, and we have the fixed income hedge funds performance over the last 3 years. So our decision basically is going to depend on how much we like to be in charge, and of course, how much we would like to pay. Because as we all know, hedge funds have really big fees, the famous 220 rule. So of this 5.78, we're not gonna get the 5.78 because we have to pay 20% in fees, and of course 2% of assets under management that we have with that hedge fund. But if we don't decide to go to fixed income, there's another way. So now Nick is gonna talk about it with you guys.
So now look at the gold as an investment option. And first thing that's worth saying about gold is the major flaw that it has is that it doesn't have any income attached to it, as in the case with bonds or stocks. So the gold has been largely criticized for that and by important investors like Warren Buffett, Charlie Munger, and many others. But gold at the same time has a lot of advantages as well. And two really major ones is its relatively low variance of returns compared to other assets, and also low correlation with other assets. Both of these advantages make gold a great asset to have in your investment portfolio because it minimizes the variance of the overall portfolio and also improve diversification, which is really important during a recession so that your portfolio doesn't struggle. The good thing about gold and other commodities is that they hold their value and it's really good to use for storing of wealth. And now we can see the graph with a historical performance of GLD ETF, which is the largest ETF investing in gold. And here we can see clearly that gold has performed really great during the Great Recession and after the Great Recession. So between 2007, 2011, and also during the COVID crisis, 2019, 2020, you can see during both of those periods, gold had hit its historical price maximums. So that's saying something. And now we're gonna see the next graph where gold curve is compared to federal funds rate hikes. And from this graph, we can see that gold kind of has a correlation and performs really well, like a positive correlation, and performs really well during interest rate hike cycles. In the last 12 cycles from 1971, gold has gained on average 29.2% during each cycle. And right now we are in a rising interest rates environment, so gold can be also a good investment opportunity for immediate investment. Finally, let's look at the graph that compares the performance of the TLT and the GLD funds. Here we have more than 10 years of data that makes it easy to say that data is statistically significant because 10 years roughly represent one economic or business cycle. And in this time frame, we can see that the graphs move almost in the same way. So the correlation is pretty high. So looking at this graph, we can say that there is no difference for us whether to invest in gold or TLT, but gold has different properties and TLT has different properties, and they both have their own advantages and disadvantages. And Harsh is going to sum it all up in the conclusion. Thank you.
Thank you, Nick, for the insight on gold investing. So what do we know till now? The first graph shows inflation is high. Currently, it's the highest since 1981 and 4.1% more than the 3-year average. The second graph shows the Federal Reserve approved the largest interest rate increase since 1994, making it 3.25%. In updated projections, the Fed signaled plans to lift rates by another 1.25 percentage points before the year is over, bringing the federal fund rate to 4.5% before 2022 comes to a close. The third graph shows the economy is heading towards recession, as high inflation historically precedes economic recession. In the previous slides, we discussed fixed income and gold as investment opportunity alternatives during times of recession. We'll now compare them for better understanding. So gold is often held as a hedge against inflation, increasing in value as the purchasing power of the dollar declines. However, some gold investors fail to consider its volatility as well as its opportunity cost, while others fail to anticipate storage needs and other logistical complexities of gold ownership. For these and other reasons, some view US Treasury bills as a superior safe haven alternative to gold. Government bonds are more secure and have also been shown to pay higher rates when inflation rises. The biggest draw in buying Treasury bonds instead of gold is that the former locks in certain returns on investment through coupon and interest payments. Gold has no such income attached to it. Moreover, depending on your income level, Treasury investments are typically more favorable tax-wise, whereas bullion coins held 1 year or longer will incur long-term federal capital gains tax rate of approximately 28%. Fixed income securities also have some attached costs in the form of brokerage or fund management fees. Both asset classes have their own sets of pros and cons. Now that we have compared fixed income with gold investments, let's get back to the question we started this presentation with. Which one is the best opportunity investment in the scenario of recession? It's to invest in a diversified portfolio of low-risk assets. This means a combination of fixed income securities and gold in the proportion of risk the investor is willing to take. That's the end of our presentation. Thank you, everyone.